estate investors aren't getting denied because they don't qualify. They're getting denied because they're applying for the wrong mortgage type. If you understand how non-QM investor loans actually work, you can scale faster, get better terms, and stop wasting time on wrong applications. Not knowing which mortgage to apply for could be the reason you lose your next deal, or worse, your entire investment strategy gets stuck. I'm Andrew Russell, owner and founder of RCG Mortgage, and I specialize in working with real estate investors to purchase or refinance their investment portfolio and to expedite their path to real estate riches. Let's talk about Maria, a seasoned investor who already owned 2 investment properties but wanted to buy more and more and more. So she actually spoke with her accountant, and her accountant said to try to purchase a couple more investment properties and do a conventional loan because they have the best rates. So Maria actually applied for a conventional investment pre-approval and kept getting denied. She was referred to us, and we put her in the right loan, as we've alluded to, the DSCR, a non-QM investment mortgage, and she was actually able to qualify for the one that she was looking for right away within 30 days, and she was able to purchase multiple more properties over the next several months. It was amazing. But I can hear you right now saying, like everyone always says, Andrew, it always sounds so easy. What's the catch? There is no catch. Take, for instance, Maria. She was a seasoned investor, had multiple properties already, so she's not a new or first-time investor. It was just her tax returns were showing losses on her rental properties, so a full documentation, conventional mortgage, her accountant, no disrespect, the accountant should have stayed in their lane and been the accountant, and we stay in the mortgage lane and put her in the right property type. Or, hey, Andrew, I'm sure this program that you're putting in is so easy to qualify for, right? So if it's easy, the rate must be a lot higher. The closing cost must be a lot higher. It's actually not true. This is something that we can show you. So I'm going to show you a side-by-side comparison through my eyes, under the hood again. Maria, looking to qualify to purchase a property, what it looked like on a full documentation conventional loan, why she got declined. I'm going to show you the specific reasons, easy to understand. Then I'm going to show you right next to it a DSCR mortgage, what the rate is, what the rate would be now with current market, and of course, how they qualified, which was the rent versus the payment, super simple. And then, worst case, it wasn't the case for Maria, but worst case, if she didn't qualify for a DSCR loan, if the market rent didn't cover the mortgage, we have a no ratio or no income check investment purchase where it's based off of credit and assets. Follow me, let's take a peek. All right, guys, here we are, through my eyes, under the hood for Maria Investor. So as you see, here's her information. We can keep some of the other stuff out. We don't need to know her personal information, all right, guys? But we want to see the scenario, why the conventional loan didn't work, why the DSCR loan did, the differences, and talk through it all. So from a financial info perspective, we're going to leave some of this stuff blank for now. She did have 2 mortgages. Each mortgage had a $2,000 a month payment, and we'll talk about that in a little bit for the conventional mortgage of where it's pertinent. So if we look at her loan and property, we have $400,000. That's the sale price. She was putting 25% down, which is awesome. So we got to plug in here homeowners insurance, which is about $250 a month. We have to plug in the property taxes, which was about $700 a month. And then if we looked at current market pricing, she had a 740 credit score, guys. So if we go over here, this is Loan Sifter, right? Loan Sifter is exactly what us mortgage broker companies use to qualify clients, to see what the pricing looks like. It's amazing, and it shows all the lenders we work with. It does all the shopping around for the consumer for free using our software. So if we put in a purchase price, $400,000, and we did 25% down, 740 FICO score. If we do an investment property, good old Suffolk County. I heard weather's nice this time of year. It's actually not. That's another story. And we price it out. It should be somewhere around 30-year fixed around 6.75% on this program for an investment property, right? Here's all the details. Purchase, $400,000, 25% down, 75% financing, 740 score. This is the important stuff. Investment property, 1 family, the right zip code. So let's use a rate of 6.75%. So we plug that in. The mortgage payments over here, guys, the mortgage payment is $2,895. So if we say, Andrew, what is the breakdown of that? You have a $1,945 mortgage payment. So if you did an escrow and you just paid the mortgage, that's your payment. $250 a month for insurance. Insurance is a little more expensive sometimes on investment properties. $700 a month for property taxes. So there you go, $2,895. So on a conventional loan, when it comes to market rent, they allow you to do 75% of it to wash your payment, which means it was a $3,200 a month market rent. 75% of that is $2,400, which doesn't fully cover the $2,895, so it's a little bit short. So she had a great job. You're like, Andrew, what's the big deal? How come this didn't qualify? Now I'm going to show you. So this, she owned 2 properties, remember? So this is a form that we work off of, guys, the Schedule E in her tax returns for the most recent year for investment properties, because sometimes it shows a loss. So remember, she had 2 properties. We'll call this investment property 1. We'll call this investment property 2. Now, if you remember, her mortgage payment on each was $2,000. We're going to work off of that. So she collects $2,500 a month in rent. That's $30,000 for the year. So you're like, Andrew, how's that not good enough on a conventional mortgage? Now, that $30,000, kind of trickles down here. So it'll show your expenses, right? This is a portion of the tax return. So if you subtract this from line 3, this is going to be the net. So you would think you'd want $30,000 over here to be the net. What's the big deal? $2,500 a month. That washes the $2,000. Can remove it from, their debt on paper at least, because the mortgage is covered on her tax returns. Nope, not the case, guys, and I'll show you why. Because she wrote off a ton of stuff under here. She wrote off some advertising for rent. She wrote off about $5,000 on each. Some cleaning and maintenance. Each need a substantial amount of cleaning and maintenance. That was about $10,000 each. Of course, are these write-offs allowed per IRS code? 100%. Why would you not do them? There were some issues on one of them with a tenant, so let's assume both had some issues. Let's call this another $4,000 from getting some tenants out, or God forbid, with a new one in, or there's some legal issues. She wrote off some fees there. Otherwise, repairs. This is a big bucket that some people write off repairs. Of course, if you own 2 investment properties and you spend, I don't know, $15,000 on each, which is very doable each year, renovating them, things go wrong, toilets clog. You guys have been there. These are things that cost money over time. So from a repair perspective, $15,000. So if you add all this stuff up, you're at $25,000, right? $34,000. So you have $34,000 in expenses. It's allowed. IRS allows you to write this stuff off. Now the catch is you remove these expenses from the rent. So each property on paper is running at a loss. So you went from $30,000 a year, which is $2,500 a month in income, which would wash, remember the $2,000 mortgage payment? Now it's negative $300 a month. So technically it gets added on to the $2,000. So she didn't have enough income, I remember in her example, to actually qualify. She can't carry a $2,000 mortgage plus a little bit in expense we showed, another $2,000 mortgage, right? And then a portion of this, plus she owned a home at the time. So because of this specific way, which income is calculated for rental properties off of a Schedule E, because of how Fannie Mae and Freddie Mac calculates this good old stuff, which we have no control over, she actually didn't qualify. So that was option number 1. Now, option number 2, you're like, all right, let's convert this over here to a non-QM, right? Let's convert it to a DSCR. So where do we go to see pricing on it? First, let's see what it prices at. So $400,000, 25% down. Let's do a new search. We're going to change the loan type to expanded, which covers non-QM. Us mortgage guys love pricing up deals, as we say. 25% down. Again, she had a 740 square. If you remember, guys, investment property. We have a 1 unit. Back in Suffolk County we go. Borrower paid. So now there's prepayment penalties. That's one caveat on a DSCR loan. It could be none, 1, 2, 3, 4, 5. It depends on the consumer, but typically clients are opting for a 3-year prepay. And what does it mean? It just means if you pay off this mortgage, sell the property, refinance it, there's a small fee that gets added on. But typically we're not seeing these loans pay off early or refinance early. So clients are opting for about a 3-year. This is something you can control. The higher the prepay, the better the pricing on a DSCR. The lower the prepay or none, the higher the rate, a little bit higher in closing costs. So let's meet right in the middle for the 3-year. And let's go to a DSCR mortgage right here. And they asked the debt service coverage ratio. Let's assume a 1-to-1 for now. 1-to-1 means, is the rent covering the mortgage on a 1-to-1 basis? So let's start there. Let's assume that it does. All right, let's see what a price is at, and we'll go from there. All right, so here goes. Wow, so it starts at 6 1/8. It's only an eighth higher. right? Which is going from denied to qualified, and the rate's only an eighth higher, which is somewhat nominal. So now the new mortgage payment, you're at $2,920. So again, that's broken down with $1,970 for the mortgage for principal and interest. You have $250 for the insurance still. You have the $700 for the property taxes. So that $2,920, that's the new mortgage. Now the way these are actually qualified and calculated, of course, which is what we went over. So it's different. You know, here there's no 25% expense or vacancy factor. The $3,200 a month is enough to cover the mortgage. So technically, let's see what the true coverage is. So if we take the $3,200 in rent, which is what you do, take the rent divided by the mortgage payment. Yep, old school calculator, baby. It's a little over a 1.09 ratio. So technically, if we wanted to price it up right, we'd come over here, DSCR, it's actually 1.09. Maybe pricing's a little bit better. Maybe, maybe not. No whammies, no whammies. And it's, you can cut the tension with a knife, exact same. So sometimes, say the DSCR coverage, meaning it was a 1.25, which would mean, you know, say that $2,920, if the rent was $3,650, for argument's sake, I just want to show you guys, would the pricing be better if the rent was a little bit higher? There are instances where it is if the rent's a lot more than the mortgage. So the 6,875, right, it goes down an eighth. So it's only an eighth savings, but it does show you if the rent was a little bit higher than the mortgage, nominal but still higher, then the pricing would get a little better. So 6,875, this is the exact program that she qualified for. So how did she qualify? Remember that whole example that we looked at, this form? We're not even submitting it, don't need it, they don't care. You know, they're of course gonna look at the credit profile. She had a 740 score and she had paid her mortgages on time, but none of this stuff goes to the lender on a DSCR. So you say bye-bye to this form. They're just going to go off of the market rent, which was, again, you see $3,200. Does that cover the $2,920, which it does? And it's just that simple, guys. So this is exactly how she qualified. I also want to show you, God forbid, say for instance, there was, you know, the property wasn't commanding a lot of rent, or I don't know, some crazy scenario that, you know, say for instance, the market rent was $1,500, like something absurd. You know, and for whatever reason, if in the area, she thought it was a great value, there's a lot of equity, whatever it is. This would then turn into a no ratio program because clearly the market rent's not covering. So that does actually exist. There are no income check investment programs, no ratio with 25% down. So the catch is, if this is the market rate, guys, 6,875 for the original DSCR, do you want to know what the market rate is for these no ratios? Still a good program, but it goes up to 8.5%. So that 2,920 goes up to 3,256. So it's, you know, it's a couple $100 obviously higher. But again, this program, which is cool, would go off of no market rent. So straight up 25% down. Does she have enough money to close, which she does? What's her credit score? And she will qualify. So not only, she did, again, if you follow, she didn't qualify for the conventional mortgage. She qualified for DSCR, but for whatever reason that market rent wasn't there and it was low and she just wanted to buy, it was a great investment. Everyone has their reasons. She would actually qualify for this program specifically, the no ratio program. The only caveat is obviously the payment's going to be a little bit higher. So there you have it, guys. We just gave you a clear-cut example of Maria Investor. She wanted a $400,000 property, 25% down. We showed you why she didn't qualify for the full doc loan, conventional. It's just specifically because she wrote off so many expenses on her tax returns, it rendered her not mortgageable for Fannie Mae, Freddie Mac. We then showed you how a DSCR mortgage rate was an eighth higher, and she qualified. But worst case, if the rent wasn't there and she still loved the property, wanted to buy with 25% down, it's doable. Rate's a little bit higher, of course, but it is something that's doable. So guys, check out my description right now. Hop in the description, click the link. There's going to be an investor cheat sheet, a guide to all non-QM investment mortgage types, you know, these DSCRs and everything we went over. So right now, hop to the description, click the link. These get a little bit confusing. You know, I do a good job for sure slowing down and going over this pretty much in detail. But if you want to do it at your own time, check it out. Click the link. It's in the description, the investor cheat sheet. If this video helped you, the next video you have to watch is buying a $700,000 investment home with no income docs. Here's the math. Make sure you watch it, guys. It's going to be great.